Hello everyone, it's Yashar here, back again with another video, and in this video I'm going to talk about Thomson Reuters stock. This is a requested video from one of our subscribers, and yeah, I researched this stock during the last week. This is an interesting business for me as I was directly using one of their services my whole life, but I never really looked into their financials and the stock itself. Outside of YouTube and investing, I'm a scientist and I always perform research and write articles as part of my job. And one of the crucial services that I use in my work is Thomson Reuters Master List, or known as Journal Impact Factor, which in simple terms describe the quality of an academic journal by a number which is an average number of citations for the research articles published in that journal. This service is widely used in academic and industrial research, and because of that, it was interesting for me to dive into financials of this company. In this video, I will discuss their business, the future plans for 2022 and beyond, the dividends, the risk associated with this company, and finally, I will provide a detailed stock analysis using my personal discounted cash flow model, and will then provide you with the fair value of this stock depending on your investment goals. The company HQ is located at Toronto, and their shares are traded on TSX for almost 131 Canadian dollar at the time of recording this video. They pay a modest quarterly dividend with a yield of 1.72%, and the market capitalization of the company is around 64 billion Canadian dollar. Before starting the video, I want to emphasize that I'm not a financial advisor, and this video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. Thomson Reuters, in simple words, provide business information services, and it has 5 segments. Legal professional segment, which provides research and workflow products focusing on legal matters. Corporate segment, which provides a suite of technological solutions for legal, tax, regulatory, and compliance issues for companies. Tax and accounting professional segment, which offers research and workflow products focusing on tax, accounting, and audit. Reuters News segment, which provides business, financial, national, international news to professionals through desktop terminals. And Global Print segment, which offers legal and tax information primarily in print format to legal and tax professionals, governments, law schools, and corporations. They call the first 3 segments, legal, corporate, and tax and accounting segments, Big 3, as they bring in most of the revenue, and if I want to be accurate, 79% of the total revenue of the company for this business. And Reuters News and Global Print does not bring in much of the revenue. Here we can also see the list of their actual products and software in each segment of their business. The company has planned to invest on fewer but bigger bets in the future, and also wants to focus on small businesses and small companies instead of large businesses and government. They plan to invest more in their cloud business and digital sales, and reduce their physical footprint as much as possible. They already reduced their call centers from 99 to 77 and office locations from 102 to 46. They were also able to increase their digital sales from 7% to 29% of their total sales in 2021, which seems in line with the company transformation to digital products and cloud services. By 2023, the company wants to transfer more than 90% of their revenue to cloud-based services, which can result in huge decline in capital expenditures and much more saving, and as a result, increase in their profit margin, which means more growth and better return on investment for investors. Overall, it seems the future of the company is digitalization and migration to cloud services. The company anticipates to be able to organically grow their revenue by 6 to 7% year over year, particularly in Big 3 segments by 2023, and at the same time increase their earnings margin by another 7 to 10% as a result of digitalization of the business. This can result in huge increase in free cash flow of the company in the coming years, if the plan is successful, of course. According to their estimations, the free cash flow of the company in 2023 should be close to 2 billion Canadian dollar per year, which is an amazing number. If we look at the past few years, we can see growth in the revenue, earning per share, and cash flow. But if we zoom out, we can see that overall they had up years and down years in terms of the cash flow in their business, and it wasn't always a growing cash flow machine. I think the company plan to move to cloud services is a nice move, and it will improve their margins, and overall I believe the business will grow in the coming years, but it is difficult to say if they can hit their own targets or not. Thomson Reuters pay a modest dividend with a yield of 1.72% at the time of recording this video. The company, however, has a long history of paying and increasing its dividend year over year. This chart demonstrates that from 1993 to 2022, they increased their dividend every single year, which is an amazing track record for the company. Last year, they just increased their dividend by 10%, which shows that they still want to continue to increase the dividend in the coming years. And overall, if you're able to lock in a good yield on cost, you can just basically enjoy year-over-year increases in the dividend with this company. Thomson Reuters is a relatively low-risk business. They have $3.7 billion in debt with a net debt to adjusted earnings of only 1.6. And they have almost $1 billion in cash on their balance sheet, with $13 billion capital capacity for possible acquisitions and growth investments. It's highly unlikely that the company can go underwater anytime soon, and their business model is low risk as they provide services to both small and large companies and governments. This is my favorite part of the video, where I can show you my stock analysis based on financial data I discussed in the previous part of the video. I use a discounted cash flow model, which basically estimates value of stocks based on projections of their future cash flows. So I make some assumptions about the growth of the company in the next 10 years, and then discount the future cash flow into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter free cash flow of the company, and based on 3 different scenarios, I predict the future cash flow of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can only grow 10% in the short term, and then the growth will drop to 8% for the long term. I consider terminal multiple of price to cash flow of 12 for this case, which is consistent with historical bear periods for this business. For normal case, I consider a little bit better growth and a terminal multiple of 20, which is the historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business grow by 22% in the short term, and then the growth rate drops to 16% in the long term, which is really optimistic. It means Thomson Reuters is able to not only grow their business, but also significantly increase their profit margins in the coming years. I consider a terminal multiple of 28, which is definitely a bull multiple for this company when it grows super fast. Now I assign 50% chance to the normal case, 20% chance to the bear case, and 25% chance to the bull case. For growth stocks, I usually expect 15% return, and for dividend stable stocks, I expect 10% return. If I expect a 10% return from this company, from this stock, the fair value of the stock is approximately 80 Canadian dollar, which means compared to current share price of almost 131, the shares are traded at 38% premium, and it is not a buy according to the model. It means if you expect 10% return on your money year over year, this stock is probably not going to deliver than 10%. However, let's change my expected rate of return to 5%. As you can see, we are almost there, and the current share price is a fair value for 5% return year over year on your money. So if you're happy with 5 to 6% return year over year, the stock is a buy today. But if you want 10% return, you have to probably wait for a dip to buy in. It's always fun to see what analyst predictions are for a company, and according to Yahoo Finance, the analyst price target for this company is currently at $151 per share for 2022 with a buy rating. Thomson Reuters is an interesting business with different sources of earnings and a very low net debt to earnings ratio. They are transitioning their business to cloud services and expected a good growth rate in the next couple of years. However, I'm not personally buying the stock at this price, as it probably cannot provide 10% year-over-year return, and we'll wait for a dip. I hope you enjoyed the video, and if you enjoyed the video, please leave a comment, let me know what stock you'd like me to review next, and please consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.